lots of talk about competition in the streaming space coming on this fall. I wonder, I mean, people do, in the US in particular, I want to talk about, they do churn off of Netflix already. So based on what we know about why, how are these new services going to affect that, and how much does that play into this target adjustment?
So as we see competition, it could certainly lead to increased churn as people come on for different titles. Our bigger concern around competition is more about content inflation. So we think that SVOD content investment could go from about $15 billion to almost $40 billion over the next couple of years, and we think that could affect Netflix's longer-term ability to, grow profit margin. As it relates to churn, we have less of a concern, so not really that much in play.
Is that because of more shows, more expensive shows? I mean, why would they spend so much more?
A little bit of both. So the price for an individual piece of content is going up as more people enter the market to bid on that piece of content. And as we've seen Netflix over the last couple of quarters, they need a lot of content to keep these subscribers from churning off, like you had mentioned.
Okay, higher costs, but could you see lower prices for Netflix to compete with all these new services coming on the market?
So we see some lower prices perhaps in international markets to grow in places like India. We wouldn't expect them to necessarily lower prices here in the U.S. We still think there's a pretty good value proposition relative to, say, some of your traditional cable costs. So we wouldn't see them slashing price here, but their ability to, say, raise price more aggressively in the coming years could be a question as competition.
So how does Netflix ever turn a profit? I mean, if content costs keep going up, and now there's sort of a ceiling on how much they can raise prices with these powerful entrants coming in with lower price services, does their data just have to be that much better that they can hit a bullseye every time with every show?
Well, that's, I think, the problem with shares. Well, what can they ultimately turn as a profit? They're already profitable in the U.S. and very profitable in terms of the income statement. Longer term, what you've seen are the long-term profitability estimates in question as they have to spend more on content, as perhaps pricing internationally comes down, and that is going to perhaps plague shares over the longer term.
Can they bend their principles and go ad-supported? I mean, they've talked about no, never, never, never for so long.
It's not something that we would expect. Obviously, there's a lot of money to be made there, but Netflix doesn't necessarily want to go head-to-head with the likes of Facebook and Google in terms of driving ad-supported dollars. And their value proposition is very much watching now and binge watching, and adding kind of ad-supported into that model doesn't necessarily fit what they do. So we wouldn't expect them to bend their principles in that way.